Welcome to the Rational Egoist. I'm your host, Michael Liebowitz, and we've got a special treat today. We've got a guy on today who is not only an objectivist, but he's also the author of the book, The Moneyball Method, a middle-class manifesto for objective investing. He also writes a Substack that I've been reading through, and it's very good. And I think we're going to have a great discussion today. Mark Shupe, welcome to the show.
Michael, thank you. I appreciate the invitation. I'm excited to be here and look forward to talking to your audience.
The first thing I want to talk about is you're an objectivist. I'm assuming, based on everything I've seen you write, you're an objectivist. If you weren't, it would be a little strange. But so you are an objectivist, correct?
Yes, I am. And I would say that I became more fully versed in objectivist principles after studying OPAR about 5 or 6 years ago, but I've been reading Ayn Rand since, for 20 years.
Awesome. I've got my own beat up copy of OPAR right here. What attracted you to objectivism to begin with?
I don't know exactly, other than I had a very positive impression of Ayn Rand without really knowing anything about her. I knew that she was a maverick, that she was an individualist, that she was pro-liberty. And I read an article in the Wall Street Journal back in the mid to late 90s that covered a speech that she had given, and something stuck with me. In that article, she said something to the effect that if you can't explain it in layman's terms, then you don't understand it. And I thought that was interesting. And as a young boy, I grew up with my grandfather, who was the intellectual of the family, and he had Atlas Shrugged and The Fountainhead on his bookshelf. So I was familiar with the titles. I was able to acquire a copy of The Fountainhead and read that. And that was about 1999, I believe. And I was not a voracious reader. I didn't fully understand a lot of it. I thought it was a fascinating story. Clearly, Howard Rourke was an individualist with integrity. I did not understand Dominique. I did not understand Gail Wynand, but I did understand Peter Keating because I saw myself in him. And that was an eye-opener. So the next year I read Atlas Shrugged. Again, that took a very long time, but I knew that I was reading some very dynamic, fascinating ideas that struck a chord with me, and I needed to learn more. And I think from there I went to Capitalism, the Unknown Ideal, or The Virtue of Selfishness, one of the more compelling, controversial titles, and started reading her nonfiction. So over the course of several years, I had become a fan and a student, not in a great serious way until maybe about 10 years ago.
When you said, you're not the first person, by the way, that said it to me, that when reading The Fountainhead, they saw themselves in Peter Keating. When I look back on my life, I don't know if I recognized it at the time, but when I look back on my life, I can certainly see what Ayn Rand called the second-hander in myself, trying to impress other people, not really looking for my own values. And I think that that's an important virtue. And I'm guessing as we get into your investing, it's important to be honest with ourselves about our limitations, our strengths, where we need to change it and grow. A friend of mine actually read the book, The Psychology of Self-Esteem by Nathaniel Branden. And when he read that book, he had a very adverse reaction to it because he saw a lot of the negative traits in himself. He actually got mad at me for loaning him the book, but he was able to take the criticism of himself and grow, and that is vital. So your book is based on the Moneyball Method. The Moneyball, of course, was the movie. It's a book, and it was about Oakland Athletics with their general manager, Billy Beane.
Yes.
And I think you summed it up as basically it's getting the most for your buck, right? Maximum return, minimal investment kind of thing. But what I'm interested in is how do you tie that? Because your book is called A Manifesto for Objective Investing is actually the subtitle. So how do you incorporate the two, the objectivism philosophy on the one hand and the Moneyball method on the other hand?
Well, Thank you. Yes, clearly the title is, I've borrowed it from the hit movie starring Brad Pitt, which is from the book by Michael Lewis that was published in 2005 about the 2002 Oakland Athletics and how they won the division, the Western Division of the American League, with the second lowest payroll in baseball after losing their three-star players. And what Billy Beane did is he had to replace the scouting department with objective evidence, with statistics that were reliable, statistics that gave him a clue as to what it takes to win baseball games with cheap talent. Now, he needed to identify the people that could help him win games and therefore sell tickets and therefore help the new ownership team, make a profit, because that was his mandate. The team had been competitive but losing many millions of dollars every year prior to the new owners taking over in 2001, I believe. And Billy Beane was the general manager, and the mandate was make a profit, earn some money. And he had to do it with the second lowest payroll in the league. And that meant changing everything. The traditional best practices were not going to work. He needed to evaluate talent in a much different way and do it under ridicule from the baseball press. And he had down the hall in the janitor's closet a couple of kids with laptop computers and a database of statistics compiled from Baseball Abstract, a newsletter for baseball fans that included statistics for minor league and college players and what those number crunchers, those quant guys, so to speak, quantitative analysis, were able to educate Billy Beane about what players could control that would help the team win games. And so what they did is they replaced all of the statistics that we all commonly know as baseball statistics, things like RBI and batting average for batters, earned run average and wins for pitchers. Those things were no longer viable. They did not guarantee success. So essentially what I've done in terms of financial and investing and advising clients is, what are the things that we can control? What are the statistics that are the most reliable to help you win your lifelong aspirations and goals with investment strategy and cash flow management? And that's a long answer. I'm not sure if that answers your question.
No, it does. Now, because sometimes objective evidence, facts, run counter to what we think. Like when I was a kid, I remember the power hitter used to bat fourth in baseball because it was assumed he's the cleanup hitter. You want three guys ahead of him. If they get on base, now he can knock all those runs in. But I notice now when I watch it, oftentimes the best hitter, the power hitter, they'll put him second. Now, because they've done what they call analytics and they figure out what actually works. And so it seems to me that the same would apply to investing, something about which I know nothing, but nevertheless, I would want to look at what actually works rather than at what intuitively I would think work. And you said about what we control, and I noticed you mentioned in one of your Substack articles, the serenity prayer. The serenity prayer, of course, God grant me the serenity to accept the things I cannot change, the courage to change the things and the things I can, and the wisdom to know the difference, meaning there's an emphasis in what I can control. Ayn Rand, of course, called it the metaphysical versus the man-made, right? There's facts that we can't change, but there's things that we can. So that makes perfect sense to me. I'm actually surprised at how well you tied the two together. You also mention in your Substack articles the dichotomies. Now, anybody familiar with Ayn Rand knows that she is not a fan of dichotomies. She's a fan of integration. So, for instance, she said there's no dichotomy between theory and practice, no dichotomy between reason and emotion. And I'm wondering if you could just explain to us a little bit more than I just did about these dichotomies and how you find them relevant in what you do.
That is a very interesting topic. Thank you. Theory versus practice. One of the theories that dominate the traditional investment advice industry is predict the future and beat the market. If you can outperform the S&P 500 or the Russell 3000, then your likelihood of success has gone up. That is not necessarily true, but it sure sounds good in theory. If you can predict the business cycle, the state of the global economy, then you can position your portfolio in the companies and industries that are most likely to benefit. That is the theory. It does not work in practice. So the theory and practice dichotomy is rife throughout the financial and investment advice industry. And what I've done in my book is identify all of the ideas that go into the propositions that lead to the practices that don't work for the individual investor, and I've replaced them with principles and with propositions and procedures that actually are reliable and I can prove it. For example, many people believe that your investment strategy, meaning your asset allocation, how much you put in stocks, bonds, and money market funds, is the primary determinant of investor success. But it is not. In a world where you do not have cash flow, then that might be true. But people that can fog a mirror, people that have a heartbeat, people that are working and living for most of their lives and then perhaps retiring later, they have cash flow expectations. They have cash flow needs. They have needs and aspirations that they need to fund for their lifestyle, their goals, the things that make life worth living. So cash flow has a big impact on success and failure. In fact, what I've discovered is that one of the greatest determinants of failure is overspending risk. So we focus on cash flow as one of the primary determinants of success or failure. And another one that helps determine success or failure is the order or sequence of investment returns that you might actually earn. Now think of that in terms of cash flow is that which we can control. We can control our savings habits. We can control our spending habits. That has nothing to do with anything other than our ability to earn and what our goals and needs are. But we cannot control is in future investment performance. No economist can do it. No global strategist can do it. No fundamental analyst can do it. Nobody with charts and graphs can do it. They all claim to be able to do it. That is their value proposition, and it's not reliable. What we do, and where this ties into the Moneyball, the baseball analytics, is use computer simulations about the likelihood of certain outcomes with regard to your unique cash flow situation, your age, your life expectancy, your financial resources, the tax category of those resources, because taxes are something else that we know about, and we can manage that. And then simulate all of that against the uncertainty of the future. So that is the practice that we implement to replace the scouting department, to replace the economic forecast, to replace the market predictions. Instead of trying to outperform the market, and risks that we can manage, that we can control, is underperformance risk. So essentially what I've just given you is 3 risks that are ignored by traditional best practices, 3 risks that we pay very close attention to, and that is sequence of return risk, overspending risk, and underperformance risk. Those are the things we can control. That is where the wisdom from the Serenity Prayer comes in. And it ties in with Billy Beane's philosophy as well. What could he control? More importantly, what could his players control? That's what he needed to discover. So, getting back to baseball, it's an unusual game because it's really a duel between pitcher and batter. It comes down to that. So statistics work really well in that scenario. What is the goal of the batter? Get to first base, meaning don't get an out. How do you do that? You don't swing at bad pitches. What does the batter have control over? Whether to swing the bat or not to swing the bat. So under the stress of being in the batter's box with a 90-mile-an-hour sinker, curveball, fastball, whatever they call, coming at you, you've got to make a decision. Do you make good decisions under pressure in the batter's box? Do you swing or not swing? What is the objective of the pitcher? To get the batter to swing at bad pitches. It comes down to that. And the same thing can be applied to your investment strategy decision. What are the bad pitches that we don't swing at using the Moneyball method? We don't swing at economic forecasts written by people who have no idea what the future holds. We do not swing at anything that attempts to predict what they cannot be controlled. And it really boils down to the fact, another premise of the Moneyball method is market efficiency. Everything that every analyst and economist knows and publishes is already built into the price of securities. We can't, prices are the information superhighway. And so we rely on the price mechanism and the efficiency of markets, and then we control what we can control, and that is our exposure to market risk.
I'm glad that you brought up the prices as information. It's actually where I was going next, because I was surprised when reading your Substack to come across Austrian price theory and also the Austrian interest theory of Eugen von Böhm-Bawerk. And briefly, von Mises put it out, and of course Hayek developed the idea that prices reflect value preferences. So if we follow prices, we can see what people in a given market are demanding by where the prices are. And the Austrian time preference theory is that all things remaining equal, a person wants a given satisfaction now rather than later, which is why we end up with interest. And I'm just curious about how you got into, aside from Ayn Rand's objectivism, but then the Austrian theory, which is largely focused on microeconomics, right? It's that economics is about the decisions of human individuals. It's not about aggregates. And that ties back to the prices and the values of the individuals in the market. But how did you not only find that stuff, but then also incorporate it into your method?
I think it was around 2002, 2003. I was a branch manager for a major Wall Street wirehouse brokerage firm. I was also the regional training manager. And as such, I was looking for ways, ideas, methods to help the new financial advisors that I was hiring and training and bringing into the firm to become more successful. The success rate was fairly poor. And I was working with a consultant who had visited my office, and he helped us with training not only experienced and successful financial advisors develop their value proposition, but also helping me with some of the younger people that we had hired. And he handed me a white paper. And the white paper, the title was Understanding Monte Carlo Simulations. It was written by David Loper. I was not familiar with that concept. I did not know who that author was, but I did notice the subtitle on the white paper. It said, if you perceive a contradiction, check your premises, Ayn Rand. That got my attention. After discussing the use of Monte Carlo simulations for advisors to help their clients with their investment strategy decision, I studied that white paper in detail to understand what these contradictions were, how they applied to the traditional advice model that we had been teaching our trainees with little success. Called the financial planning department to see if they offered anything similar. We did not. And to make a long story short, I ended up subscribing to or enrolling in the certification program that was offered by David Loper's firm to learn more in detail about how to implement this process. In other words, how to fire the scouting department, use empirical evidence, objective data, and help people live the one life they have with confidence, avoiding unnecessary investment risk and unnecessary sacrifice to their lifestyle. So that was the beginning. And then a couple of years later, I joined the trust department of a major regional bank. I was a trust officer and portfolio manager, and I was able to implement this particular set of procedures and the philosophy of objective investing for the next 10 years with real life clients that were entrusted to me at the trust department within that bank.
I learned something, and I've read a lot in my life about self-improvement, motivation, goal setting. But you wrote something, and I wish I'd remember. I wish I would have chronicled which Substacks I was reading. But you talked about the goal of making money, and you said that you first have to know what you want the money for. Why do you want this? Because, and I've experienced this myself. I want to be rich. Everybody wants to be rich, but they don't put a why behind it. What you did is say, no, you have to have the why. What is the reason you want it? And then you aim for that. Was that an original creation of yours? Did you learn it somewhere else? Is it a combination of things? Just explain it, but explain it better than I did.
I think the original inspiration for that comes from Ayn Rand. She just goes into a great deal about values. Values are primary to living a life of meaning and purpose. And she said, a value to whom and for what? That translates to make money for what? And it's important to define the cash flow objectives we're trying to fund. And David Loper put it in other terms. He said it's dreams, dollars, and deadlines. What is of value to you? What are the tangible concretes that will help you achieve those values? How much do they cost? When do you need it? That is what we are trying to put a dollar amount and a target date on. Those are the cash flow objectives we're trying to fund. And I think you've hit on the essential difference between the Moneyball method and the traditional model. We measure performance looking forward. What are the dollars of future wealth that define success? And it's about defining success. What does the traditional investor, both advisors and their clients, it's a feedback loop of predicting the future, beating the market. Did we beat the S&P 500 by how much? It's backward looking. The industry, and that's the institutional model, and that's fine for institutions that they're not individual investors. Their performance is based on looking backward against an arbitrary benchmark. And what I do with the Moneyball method is change the benchmark to the future, dollars of future wealth instead of historical percent returns. Because getting back to your question, to make money for what? What is money other than what you can convert it into? It's the exchange value of money that gives money value. Money has no intrinsic value. You cannot eat it. You cannot, travel inside of it and go anywhere. And I also have to give credit to the finance editor of Real Clear Markets, John Tamney, who wrote a book called The Money Confusion. And he really helped me concretize what money is, where it comes from. And he quotes, I believe, I don't know if it was Carl Menger or another famous economist, you don't buy anything with money. You buy things with the material and labor and services that created the money in order to buy something, other material, services, and labor. Money just assigns a value to that transaction. Money is production. Production is money. And if we have a healthy respect for money, and in my book, I give it another term. I go, money is the legacy of a productive mind. Money is not the root of all evil. Money is not to blame for anything. Money is a tool. We all know about Francisco's money speech. That's all. There's a good source of where I learned this. Money is a tool. It does not replace you as a driver. So in the Moneyball method, it's to make money for what? Once we define what that is, then we can take the next steps and avoid unnecessary investment risk, and preserve dry powder for the future in case we have a market calamity, which we will, or another event that unexpected use of money that we didn't anticipate. So it's really about trying to anticipate the future and can control what we can control.
You also incorporate emotional intelligence. I first came across the concept of emotional intelligence, I think in 1998 or 99 in the book Emotional Intelligence by Daniel Goleman. Good book, not fantastic. There's some things in there with which I differ, but by and large, I thought it was a good book. Now, you kind of have I'm not going to say different, but your definition of emotional intelligence kind of differs from his. What is your definition of, and if you don't remember it exactly from the article, that's fine, just your general idea of emotional intelligence, and how is it applicable?
Well, I am not a psychologist, and I do rely heavily on Dr. Gina Gorlin and Dr. Edwin Locke when discussing these things in my book. And essentially, your emotions are a automatized response, and they can either be rational or irrational. And what we want to do is have intentional, rational ideas that program our emotions. But ultimately, it kind of boils down to goals and objectives. The goals are the concretes that we can put a price tag and a time frame on. The objectives are the emotional feedback, the ultimate payoff, the pursuit of happiness, if you will. And I think the best source for that is Tal Tesfani's recent book, Secrets of a Passionate Life. If anybody wanted a primer for my book, or a primer, however you pronounce it, read his book. I mean, I go into some detail with some of Tal's ideas in chapter 8 of my book, and I do give him credit, attribution for that. But it's really about, what are the goals and aspirations that make your life worth living? The values that result in pride, happiness, satisfaction, confidence. I hope that answers the question.
You also talk about dealing with changes in life. And I'm somebody that does not deal well with change. I've had to train myself and continue to train myself to deal with change. If I'm expecting things to go a certain way and then they don't go that way, the panic starts to go off. But I'd imagine that in being an investor or getting involved in investments, you have to learn to be okay with change, right? I mean, it just seems like it's a must.
Yes. And when you're dealing with money and investing in the uncertainty of market performance, change can hit you in the face. And what this method allows us to do is anticipate the possibility of extreme markets, large deviation events. You can call it a market crash, you can call it a meltdown, you can call it a correction, call it whatever you want. That's one change that might affect your net worth, might affect your spending capacity, might affect you emotionally. And the traditional investment model does not do a good job of anticipating those possibilities. And what I do, and I mentioned risk capacity, I think what's a calculation that we do once we know what our cash flow objectives are, once we know what our net worth and tax status is, once we know, our age and life expectancy, have that in good order. We calculate risk capacity. How much can you afford to lose before your plan becomes underfunded? And if it does become underfunded, what do you do next? What is plan B? Is there a contingency plan? With the clients I work with that have practiced the Moneyball Method, there is a contingency plan. If there is a major market correction of some kind and it affects your net worth and you become underfunded, we know what we're going to do because we already calculated the impact. We calculated the likelihood of it happening, and it's never fun. I mean, nobody likes to lose money. And when I tell people, if you compare the current value of your account against its all-time high, you will be disappointed. But nonetheless, that's just one thing that might happen in terms of an unexpected event, and that would change your like what I call it funding status. We try to remain fully funded at all times.
All right. The last question I got for you, Mark, before I can figure out where people can find you. The book is a middle class manifesto. Why middle class, and how does middle class, the method for the middle class, differ from, say, your top tier investors?
Two things. If you are an entrepreneur, closely held business interests, that dominate your net worth, it's difficult to model that using probability analysis. If this is geared to people that have money in 401k plans, in 403b plans, in mutual funds, in brokerage accounts, I would say that this is very useful for anybody in today's value of currency. If you have less than $10 million of net worth, then this might be very useful. But if a lot of that is tied up in closely held businesses or private equity or something that does not have a track record of performance that we can model using our database of capital market assumptions, then or if you've got a net worth of that's far north of $10 million, and cash flow is not an issue. As I mentioned earlier, two of the greatest determinants of success or failure, timing of cash flow and sequence of returns. Well, both of those apply to people that have a lot of their net worth in marketable securities through qualified retirement plans, mutual funds, and brokerage accounts, and annuities, whether they be variable annuities or fixed annuities or bank accounts. So yeah, very high net worth people, cash flow is not an issue. People that have a lot of money tied up in illiquid assets and closely held business or real estate, those are difficult to model.
All right, Mark. So where can people find you and find your work? And by the way, I will attach a link to both your Substack and your book with this episode so that people can just go find it there. But other than that, where can people find you?
Well, thank you. The book is on Amazon, and The Moneyball Method is the title. Moneyball Method /.substack.com, or I'm not sure, is it /Substack? Moneyball Method without THE in front. Substack is where I am publishing articles, usually 2 or 3 a week, and they're short, 400, 450 words. I want to keep it easy, digest this in small pieces. There is also a Facebook page titled The Moneyball Method, where I'm currently working on building out a website dedicated to the book and dedicated to distributing these. We are just recently started posting shorts of the podcasts. We're doing a podcast once a week that will be on my Substack page and then also on YouTube. You can find The Moneyball Method on YouTube. Granted, Moneyball is not an uncommon term, so there's a lot of different Moneyball on YouTube, but I'm on there, and it'll start getting more traffic as I'm posting more content. And I think those are the only resources right now.
Awesome. Check them out, folks. The Substack is excellent. I've been reading through the articles. Plain language, well written, good stuff. Highly recommend it. Please check him out. He's Mark Shupe. Mark, thank you so much for being here today. Really appreciate it.
Michael, I appreciate it as well. Thank you, and have a wonderful day.
Well, for now, this is the Rational Egoist signing out. I'm Michael Liebowitz. Till next time.